Okay, so you are welcome to another class. We could not have our class last week. We had it virtually, but I saw that a lot of you didn't join. I hope you have looked at the recordings of the class. So last week we looked at IFRS 16. We finished it up. Yeah, it has been there. The night I finished it was when I posted it. Surprised you're asking that after how many weeks? Okay, so far we have looked at how we account for assets so far, how we account for assets. Today we are going to further on that, on how we account for assets. We have looked at tangible assets, which has to do with IAS 16 on PPE. We have looked at intangible assets, which has to do with IAS 38 on intangible assets. We have looked at if you lease those assets that you don't have to buy them outrightly, that you lease them where they allow you to pay for several years. We have looked at that scenario also, how to account for it from the standpoint of the lessee and also from the standpoint of the lessor. We have looked at that as well. Now, what we want to look at today is the fact that you see these tangible and intangible assets, they usually impair. They usually impair. And we're going to learn that using IAS 36 on impairment of assets. So now, the first thing I would tell you, as far as this standard is concerned, is the objective of this standard. And this objective will guide us all through today, in the next 2 hours or 1.5 hours that we have together for today. So now, the objective of this standard, IAS 36, is that an entity must ensure that at every point in time, the value or the amount in which you recognize your assets, either tangible or intangible assets, the amount at which you recognize it or you carry it is never higher than its recoverable amount. That's the major objective, to ensure that the carrying amount of an asset, which is the amount at which you recognize the asset in your books, is never at any point in time higher than its recoverable amount. We are still going to look at what each of them means. But that's the first objective of this class or of this standard. Ensuring carrying amount is never at any point in time higher than its recoverable amount. But if for whatever reason that happens, whereby your carrying amount, you find out that is higher than its recoverable amount, then you need to prescribe and ascribe that asset as impaired. That's the second objective. If for whatever reason, if the carrying amount happens to be higher than its recoverable amount, then the asset is described as what? Impaired. Those are the two core objectives of this standard. Number one, ensuring that the carrying amount of an asset is never higher than its recoverable amount. And number two is that if it happens as such, whereby the carrying amount is higher, then the asset is said to be what? Impaired. Now, having understood that objective, that this is what we want to achieve, I need to then look at some definitions that will help us all through today. Some definitions that we need to identify. And the very first of which is an impairment loss. That's the first definition we need to look at. So what is an impairment loss? So IAS 36 says that an impairment loss is the amount, or is an amount by which the carrying amount of an asset exceeds its recoverable amount. So an impairment loss is an amount by which the carrying amount of an asset exceeds its recoverable amount. Therefore, we need to understand two things here. The first one is carrying amount, and the second one is what? Recoverable amount. Deborah. Okay, so there are two things here that we need to identify. First is the carrying amount, and the second one is what? Recoverable amount. So that takes us to the next point, which is carrying amount. So what is carrying amount? From your knowledge of IAS 16 and IAS 38, we said is the amount at which an asset is recognized after deducting its what? Accumulated depreciation and its what? And its accumulated impairment losses. That's carrying amount. The amount at which an asset is recognized after deducting its accumulated depreciation and its accumulated impairment losses. We already know this. But again, from your previous knowledge of what we have done so far, how do you determine carrying amount at the end of the year? Is there a model we use? What are the models we have? What are they? Okay, apart from those two models, do you have any other one? Fair value model. We mentioned it, but we have not really looked at it properly. Okay, good. So if you are using the cost model, then what will be the carrying amount? That's correct. What about if you are using evaluation model? What will be the carrying amount? That's correct. Fair value minus subsequent accumulated depreciation minus accumulated impairment losses. What if we are using a fair value model? Fair value. Thank you very much. Okay, now let's go to the next one, which is what? Recoverable amount. So IAS 36 said that recoverable amount is the higher between the fair value less cost of disposal and an asset value in use. Recoverable amount is the higher between the fair value less cost of disposal and an asset value in use. From here now, we can say that, in fact, they said the higher. I'll still come back at that. Why the higher? We'll look at that together. But before we look at the higher together, we need to understand what is fair value less cost to sell. You see, when you have fair value less cost to sell, then we can simply call that net realizable value. Fair value less cost to sell. But when we say fair value itself, When we say fair value itself, have I defined fair value to you in this class before? We said is the price that is received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So fair value is the price that is received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So we believe that when you get to corporate reporting, when we teach you IFRS 13 is a standard on fair value measurement. We will go deeper into this definition on how to use this definition to determine fair value. But for now, fair value here is the selling price of that asset. How much you can sell the asset immediately. If you want to sell it now, how much are you going to receive? That's the fair value in this context here. Now, the next one is the value in use of an asset. Value in use of an asset. And what is value in use? Value in use is the present value of the future cash flows from an asset including its ultimate disposal. So value in use is the present value of the future cash flows from an asset, including its ultimate disposal. That is value in use. Then coming back to recoverable amount, we said that recoverable amount is the higher between the fair value of an asset, fair value less cost to sell, and the asset value in use, the higher between the two. You see, I can interpret this as the higher between how much you can recover from either selling the asset or continue to use the asset. Because anyways, there are two ways in which you can make money from an asset. Is either you sell it outrightly and you make money, or you continue to use it. So the highest you can recover from either of the use is what we call recoverable amount. Then the core question is this. Here we are seeing the higher. Why the choice of the higher? Why not the lower between the fair value less cost to sell and its value in use? Now I need to hear from you. Why do you think they went for choosing the higher between the two? In order for impairment purposes, they said recoverable amount is the higher between fair value less cost to sell and its value in use. Why the higher? Why not the lower? What's the logic behind that? What do you say? Okay. Yeah, we want to know the maximum we can earn from that asset, right? Okay. That's logical enough. You see, when it comes to valuation of assets, in most standards you will learn, you will see that we always want to be prudent when it comes to asset valuation and reporting. So you find us saying the lower of almost in all standards, the lower of for prudency purposes. But simply because the objective of IAS 36 is mainly to ensure that the value at which you carry your assets is the realistic value. We don't want you overstating your asset. That was why the first thing I mentioned in this class was the objective, which is that you should ensure that the book value, which is the carrying amount, is never higher than its recoverable amount. We just want to ensure that don't fool yourself as an accountant. Don't overstate your asset. Let your carrying amount reflect the realistic value of that asset. And the realistic value of an asset we believe is the recoverable amount, which is what's the best this asset can do in terms of the ways it can make money, which are two, either from selling or from continue to use. So what's the best this asset can do? That's its realistic value, the highest value it can earn. We believe that that is the amount an asset should be recognized. And that's the aim of the standard. And that is why the recoverable amount is the higher between that two. Let us know the realistic value of these what? Assets. Now, having settled the core introduction to this standard, the next thing is three things that I will quickly look at. Number one is, how do you identify that an impairment even exists? Because primarily, what you will have in your books is carrying amount, is book value. It's not like you have recoverable amount in your books. We don't have recoverable amount. We usually have the book value, which is the carrying amount. So what will trigger you looking for an recoverable amount? What will trigger you to consider that there is an impairment that has occurred on this asset? So that's the first thing we need to look at, which is identifying a potential impairment on an asset. That's one. Number two, we will then look at how do you then determine recoverable amount. We'll look at that with a question. How do you determine what? Recoverable amount. And thirdly, we would look at how do you then account for the impairment loss that you eventually arrive at. How do you account for it? So let's go on that journey for 30 minutes and see what we can make do with that. So the first one is identifying a potentially impaired asset. Identifying a potentially impaired asset. So if the examiner can ask it this way, and they can also simply ask it as list the indicators of impairment. That's another way they can ask it in the exam. Indicators of impairment is also identifying a potentially impaired asset. So you see, these indicators of impairment is either is external indicators or internal indicators. So we need to look at those two. So the first one, which is external indicators, the first one, which is the external indicator. So from the name external, so these are indicators that are outside the control of the company. It's not something an entity can control. And number one indicator is where there is a fall, a fall in the market value where there is a fall in the market value of an asset is an indicator of impairment, though it's external because it's determined by the market. Okay, so where there is a fall in the market value of an asset, this is an indicator. And you see, this fall is significant in such a way that we cannot attribute it to passage of time. That for the fact that we have used this asset for like 4 or 5 years, so it's natural that the value would fall. But this one is not like that. It was significant and unexpected, that we cannot attribute it to passage of time or usage. See, These are economic or market factors. So a fall in the market value of an asset can trigger that you should look at a possibility of an impairment. And number two is where there is a change. Hmm, yeah, you can. I hope you have one in Nigeria. When there is a change in the technological, market, legal, and economic environment in which an asset is located. So, where there is a change in the technological, market, legal, and economic environment in which an asset is located, this is also an indicator because a change in technology can trigger a loss in the value of an asset. Yeah, it could, you could forget the value of that asset as a result of change in technology, market, legal, and economic environment. If you look at with the introduction of Dangote fuel, which is refinery starting, NNPC being the sole buyer from him, you know, now most of these IOCs that had the license to import petrol before might not be able to do that anymore because since everybody now will be buying locally, usually they have this big depot because they import in huge quantities. So they have these things they used to keep them. That will not be necessary anymore. Since they are buying it locally, when they need, they will just buy. So they will need something small that the underground reservoir they have is just sufficient, like that. So what do you think will happen to those big depot? They are assets in their books, but a change in market and economic environment would render their value very low. So it's an indicator of impairment for them. Another one is where there is an increase. When there is an increase in interest rates, when there's an increase in interest rate that is used, that is used to calculate, that is used to calculate value in use, it's a potential indicator of impairment. An increase in interest rates that is used to calculate value in use. You see, I told you that value in use is the present value of future cash flows. In determining present value, you will need a discount factor and a discount rate. And for those of you doing PM and in calculating MPV, because you will have done several examples, you will have seen that the higher the discount rates, the lower the MPV. The same thing here too. The higher the interest rates that is used in calculating value in use, the lower the value in use. And because value in use is a component of recoverable amount, it could be value in use. So when your value in use is low, there is high possibility that the carrying amount has become higher than it. So it's a trigger. It's a trigger for impairment. So where there is an increase in interest rates that is used to calculate value in use. So with what is happening in Nigeria again, where we have an elevated interest rate at an MPR of 26.75%, at lending rate of over 30%, I mean, that's a trigger for impairment in this present economy that we have here. Then the fourth one is the entities, where the entity's net assets, where the entity's net assets is higher than its market capitalization. That's the next one. the entity's net asset is higher than its what? Its market capitalization. So when we have a scenario like this, where the entity's net asset is higher than its market capitalization, is a trigger, because entity's net asset is its book value. If it's higher than its market capitalization, which is for a company that is quoted, the market capitalization will be its share price, and it's multiplied by its number of shares. If its book value is higher than that, that's a trigger. That's a trigger for impairment. Okay, so these are external indicators of impairment. We could have internal indicators as well. We could have internal indicators. And what are the internal indicators we can have? Number one, if there is evidence of obsolescence or physical damage. If there is evidence of obsolescence, so if you have evidence that the asset is now obsolete, I mean, we have a new one, so we don't need that one again. So it's obsolete. Or there is a physical damage on the asset. It has damaged. Is an indicator that the value of the asset has fallen. Its recoverable amount has fallen. And we should probably be looking at the possibility of impairing the asset. Number two is where there is an adverse change, in the use or economic performance where there is an adverse change in the use or economic performance of an asset is an indicator. Because speaking of economic performance, an asset that was outputting 1,000 units per day before is now doing 700 units per day. It's an indicator that this asset might likely have been impaired, that its value is now going down, or an adverse change in the use. And an asset that you sparingly use before, maybe you use it for like once in a week, now you're using it every day, is an indicator that should trigger that there's a possible reduction in the value in this asset. That's internal indicator. And number three is where there is a decline in the useful life when there is a decline in the useful life. When there is a decline in the useful life of an asset, that is also an indicator of impairment. Because an asset that we expected that would use 10 years, now we are having information that it can only go for 5 years. Is an indicator that there is a possible impairment. Okay, so that's the first part we want to cover today. How you identify a potentially impaired asset. Is a potential 5 or 4 marks in the exam. These are things you must always do if it comes out. External indicators, internal indicators. As a financial reporting student, you must know the 7, everything. The 7. So now, one thing we just need to know is this. You see, when you do this identification, right? When you do this, when you do this or look for this indicator, what you're actually doing, we call it impairment review. We call it what? Impairment review. And if it now happens that any of these indicators is confirmed that they are present, then you have to move it to the next step or the next stage. And that next stage is what we call impairment tests. So at this stage, where you're identifying a potentially impaired asset, what you're doing is just review, impairment review. But as soon as you confirm that an indicator exists, you move it to the next stage. And that stage is where you perform an impairment what? Test. And do you know what you do at the impairment test stage? That is where you determine your carrying amount. Sorry, you determine your recoverable amount because you already have your carrying amount in your books. So all you do at the impairment test stage, you start to determine your what? Recoverable amount. And that's the step for impairment. Impairment review, impairment test. However, listen up. However, there are certain types of assets. There are certain types of assets that even if there are no indicators, even if there are no indicators, you must test them for impairment annually. You know, from what I've mentioned so far, I said the first stage is identifying whether impairment exists or not, which is impairment review. Then the next stage is impairment tests. Abi? But I'm saying now that there are certain type of assets that even if there are no indicator, that there is nothing telling you that there is an impairment, you must still test them for impairment annually. So there are two categories of assets that are tested for impairment annually. And I know you know it in this class because I've taught you before. I taught you under IAS 38. I taught you. Is there anybody that can remember? Say it again. Louder. Funny. I said I taught you something in IAS 38 and I'm mentioning PP. My friend thought Jerry. Okay. Thank you very much. Number one of it is an intangible asset with an indefinite useful life. You test those ones for impairment annually. Intangible assets with an indefinite useful life. You test them for impairment annually. And number two is goodwill that is acquired in a business combination. Goodwill that is acquired in a what? Business combination. Those two sets of assets are tested for impairment annually. Every year, you must test them for impairment. Mm. Research and development. No, no. In a business combination. Okay, so have you started group account? Oh, you just did an introduction. Okay. Yeah. Oh, okay, there are a lot of them. Okay, so let me start from the one of goodwill, right? So goodwill acquired in a business combination. So group account that Mr. Ibrahim is teaching you. So he will teach you that one company acquire another and all of that. That's business combination. Because IFRS 3, IAS 27, IFRS 10 requires that you'd you would prepare a group account for such companies, right? You consolidate the account. So that's business combination, one business acquiring another. So usually when that happens, there is usually a goodwill that arises. There's usually a goodwill because you find out that one company is now paying higher for the asset of another. So that excess amount paid, we say is goodwill. Okay? So that goodwill we need to test it for impairment annually, every year. So the second one, which is an intangible asset with an indefinite useful life. For example, now we could have maybe even your website, for example, now, okay, or you have a piece of software that you develop, okay, or anything, any intangible asset that's sorry, or royalty. I mean, as long as there is no life to it, as long as you continue to earn benefit from them till eternity, till infinity, right? Is an intangible asset with an indefinite useful life. So what we are saying here is that they have to be tested for impairment annually. You see, what I want you guys to do is to always remember this in case they ask it. It's 2 marks. It's a lot for us in the exam because you do nothing. All you need to do is just to remember it. 2 marks, right? And you're good to go. And yeah,
Okay, question 3.1. A company has a machine in its statement of financial position at a carrying amount of 150,000 naira. The machine is used to manufacture the company's best-selling product range, but the entry of a new competitor to the market has severely or severely affected sales, rather. As a result, the company believes that the future sales of the products over the next 3 years will only be 75,000, 50,000, and 25,000 naira. The assets will then be sold for 12,500 naira. The offer has been received to buy the machine immediately for 120,000 naira, but the company would have to pay shipping costs of 2,500 naira. The risk-free market rate of interest is 10%. An impairment review confirms that the asset might have been impaired. Determine the impairment loss.
okay. So the question wants us to determine impairment loss. So if you look at this question, in the first paragraph, they gave us the carrying amount of these assets. Abi? And in that same paragraph, they told us that the company is experiencing adverse sales. Okay, so this adverse sales is a trigger for impairment test. And in the next paragraph, they then gave us the future cash flows that the entity is going to generate for the next 3 years. And they also told us how much the entity can sell the assets at the end of that third year. In the next paragraph, they now told us that there's somebody that wants to buy the assets immediately, right? There's an offer. That's the fair value, that's the selling price. And they told us how much the person wants to buy it. And they also told us that we're going to incur some costs to sell. I think around 2.5. And they also gave us a discount rate. They gave us a discount rate. What that discount rate will do for us is to help us to determine our value in use. Okay? So let's determine the impairment loss. So in determining the impairment loss, the first thing we need to determine is what? Our carrying amount. And what's our carrying amount? 150. Then, of course, we know that we will need recoverable amount. But to get recoverable amount, we will need fair value less cost to sell and value in use. And in this question, what was the fair value of these assets? 120,000. What's the cost to sell? The cost of disposal is 2,500. So what's our, sorry? The cost of selling, the costs, this cost of disposal is the cost to sell, not the price they will sell it at its maturity, at eventual date. That one is different. Shipping cost is the cost of disposal here, which is 2.5, or cost of sale. So So in this class, I'll be very particular about double entry because I really want you to know it. So if I may ask you again, who can tell me what's double entry for this impairment loss? You debit the assets, yes. What do you credit? You debit the assets, you credit what? Again. Thank you, my boy. You debit P&L and you credit the assets. You said the reverse. You debit P&L, you credit the assets. You debit P&L, you credit the asset. And because you want to reduce the assets. You want to, it's a loss. You want to reduce the value. Okay, what if on the same assets there was a revaluation reserve of, let's say, 5,000? Let's say on the same assets there was a previous revaluation surplus on the same assets. Don't tell me you minus skinny. You debit OCI with 5,000, 7,360. Ogechi, Ogechi. That's perfectly correct. Extremely correct. So from the knowledge of IAS 16, you can just simply apply that here. Okay, that's good. So you debit OCI because you need to net off the surplus first. That's the first thing you have to do. And you're going to do that through OCI. So that's why you debit OCI first. So there's still an excess loss of 7236. You debit that to where? POL. And the other leg goes to where? Um, you credit the assets with the remaining total. I have this explained in your handout, but really that is how you account for impairment loss. Okay, those are the extreme scenarios you can have in the exam. Yes, yes, yes.